Hello, my name is Bergel-Grant. I'm the founder of Leapfrog Life. Today I'm going to run through with you the 2016 federal budget. So there are significant changes made, particularly when we focus on superannuation, and the first one of those are the changes to superannuation and post-tax contributions. Currently, at the moment, you can, if you're fortunate enough to be in a position where you actually have a significant amount of money outside of super, you're able to put up to $180,000 a year into superannuation, or you can use up 3 years limits in one go. You might have heard of the bring forward rule, so $540,000. Essentially, as of last night at 7 p.m, we have to be very much aware that those limits are no longer in place, and although not legislated, they have been announced. So what they are now proposing is that there is going to be a lifetime cap of $500,000, and they're actually going to go back to contributions made since the 1st of July 2017 to work out whether or not you've already reached that lifetime cap. But not to fear, if you've already put an amount over $500,000 in since the 1st of July 2007, you're not going to be penalised. However, going forward, if you breach that cap, there are certainly going to be significant penalties in place as they currently stand if you were to breach the existing caps. The other thing that's also changed are pre-tax contributions to super. So this is money which perhaps has come through from your employer's normal superannuation guarantee contributions, perhaps your salary sacrificing, or if you're self-employed, it could be your personal deductible contributions that you make. There are proposed changes to take effect from the 1st of July 2017, and this will see a reduction to this pre-tax limit, or otherwise referred to as concessional contribution cap, to $25,000. Currently, it's $30,000 if you're under the age of 50 and $35,000 if you're over the age of 50. The proposed changes will come into effect from the 1st of July 2017. But one of the really good things about these changes is that they're talking about the ability for you to effectively catch up on missed out contributions in previous years. And the focus here is really to enable individuals to get their superannuation balances up to $500,000. So if your superannuation balances all totaled up together are less than $500,000, you would be eligible for this catch-up pre-tax contribution. So if we look forward, so this won't count towards the current financial year or even the 2017 financial year, because the old limits will still apply. But going forward, if these proposals become legislated, from the 2018 financial year, if you don't use your full $25,000 limit, you have the opportunity to carry it forward on a rolling basis for up to 5 consecutive financial years. This is definitely going to work where we have a situation where perhaps you're self-employed and your income varies, or perhaps you're commission-based, or perhaps even simply the sale of an asset gives you extra cash where perhaps you now can afford to utilise that ability to make the contribution to superannuation. They've also removed the requirement for the work test. Currently, if you're over the age of 65 and want to be able to contribute to super, you actually have to meet a work test to be able to continue to do so. This work test will be completely removed, effective from the 1st of July 2017. However, over the age of 75, you still won't be able to make voluntary contributions. But this certainly opens up the door for you, perhaps if you're thinking about selling your home and downsizing, the ability to continue to make contributions to superannuation. But we still now have to be mindful that there is now a lifetime cap on post-tax contributions of the $500,000, as already mentioned. Currently in place for higher income earners who earn more than $300,000, are subject to an additional 15% tax on superannuation. So normally we only pay 15% tax to get money into super pre-tax. So again, the salary sacrificing, the super guarantee contributions by your employer, and personal deductible contributions by the self-employed. For those who have taxable assessable income of more than 300, that currently has increased to 30%. The proposal, again to take effect from the 1st of July 2017, proposes that this threshold will reduce for those who have an income of more than $250,000. All of these tax changes to superannuation are effectively going to be used to enable people on lower incomes to be able to put more money into superannuation, or to make superannuation more tax effective for them. So we're now going to see the introduction of the low income superannuation tax offset, effectively ensuring for those lower income earners, if they do decide to make contributions to superannuation, that it will not be taxed at a higher rate than if they were to keep that money outside of the superannuation system. A really good one, which I'm very happy to see this change, is the spouse contribution offset. Currently, if you want to be able to put money into your spouse's superannuation account as a non-concessional post-tax contribution, you can only get a benefit if your spouse earns less than $13,800 a year. So certainly for two-income families, it's often one which is immediately ruled out. Again, effective from the 1st of July 2017, it's proposed that this threshold will increase to $37,000. So certainly something if one of you are on maternity or paternity leave, or perhaps have taken some time off during the year for some reason, or perhaps back at work studying. And there's a whole range of reasons where this is a really good idea, a great incentive to ensure that your spouse's superannuation certainly doesn't have losses because they're not able to contribute at the same level that you are. The next piece of the puzzle is really interesting. If we go back to 2006 and the budget changes, there used to be a whole range of very complex, very convoluted in many ways, rules around superannuation and pensions and how much tax you paid. If we go back to that budget, effectively they removed any taxation if you're in pension phase over the age of 60. Really simple, really straightforward. However, effectively what they did was give a massive tax break for those who have significant amounts of money in superannuation. What the government is effectively now saying is from the 1st of July 2017, the maximum someone will be able to have in that very tax effective pension phase is $1.6 million as an individual. So as a couple, you could, if you both had $1.6 million to transfer into pensions, you together could have $3.2 million in this very, very tax effective environment, which effectively enables you the ability to not pay any tax on income, not pay any tax on capital gains, and if you have franking credits and invest in Australian shares, effectively while you're in this phase, you end up getting money back from the tax office because you get reimbursed the company tax rate. So the way I tend to describe pension accounts to clients is like having your own private tax island. Currently, this hasn't been limited as to how big the amount of money can be in there, but the proposal is definitely to limit it to $1.6 million. However, not to fear, if you do have more money in there, well, certainly you're in a strong financial position, but secondly, you will still be able to leave that money in superannuation phase. So that will still enable you to benefit from a very concessionally taxed environment. So I wouldn't be rushing to get the money out of superannuation. We also have the transition to retirement income stream. And for many advisors, we've been thinking since this was first introduced, it was almost too good to be true. An ability to draw an income stream, turn the money that was in superannuation phase into a pension account, get all the tax-free benefits that I was previously talking about. Effectively, what they're now saying is if you are in a transition to retirement income stream drawing a pension, you will not benefit from the zero tax status effectively. You'll still benefit from the normal superannuation tax status, which is typically 15% tax on earnings and up to 10 to 15% tax on capital gains. So for most people, still far less than what you pay for your marginal tax rate. However, it is absolutely critical to understand that transition to retirement pensions certainly won't be as effective as what they have been in the past, and there is no grandfathering allowed here. So if you're already in one of these impacts will take effect from 1 July 2017, so well worth sitting back down and revising whether or not it's worth continuing being in such a strategy, particularly given the new limitations on actually getting money into this very tax favourable structure. The next one here is removal of the anti-detriment payment. Effectively, this was prehistoric's probably being a bit unkind to it, but it was a very old piece of legislation which effectively notionally allowed a spouse or a child or a beneficiary of a superannuation benefit to effectively receive a refund of taxation paid when contributions have been made by the member over the years. A fairly complicated formula, but essentially this will be completely abolished from the 1st of July 2017. Certainly isn't going to have a huge impact for many people, but it is one just to be aware of. One of the things that I'm seeing a lot of small business owners today very happy about are the changes to the company tax rate. For the 2015-16 financial year, the current company tax rate is 30% and 28.5% for small businesses, which is currently classified as those with the turnover of less than $2 million. The government has a very strong 10-year plan, obviously still to be legislated, to reduce company tax rate for all businesses down to 25%. This may be a challenging one for them to get through the Houses of Parliament, but certainly is one which they've made very clear as to what their intentions are. For those who are invested very, very fully within the Australian share market for the benefit of franking credits, this could effectively impact the amount of franking credits that you receive back. As we can see, currently the current tax rate is 28.5% for businesses who have a turnover of $2 million or less. From next financial year, that's going to include businesses with turnovers of $10 million or less, and then gradually increase over time. To the right-hand side, we can see the proposed changes to the tax rate for those companies that are actually able to benefit from that, with a long-term goal, as mentioned, that the tax rate will drop to 25%. So thank you for your time, and hopefully that's brought you well and truly up to speed. It has been a very, very interesting budget, and if you have any questions at all, certainly you have the opportunity and the links to make sure that you're able to book a time to discuss it in more detail with me. Thank you.